We just wrapped up the most volatile week of 2024. Stocks fell across the board thanks in part to rising bond yields, telling us that the market is back to a macro event driven market. And with CPI and PPI figures dropping next week, there's plenty of macro to take us off course. So with commodities rising, should we be prepared for a hot inflation print this week? Today, we discuss that and other major macro events. Financials kick off Q1 earnings season, and with elevated valuations, we need to talk about what happens if earnings don't live up to expectations. Are we about to witness a buy the rumor, sell the fact type of earnings season? We also need to talk about the Russell 2000. Today, we break down the Russell in a lot of detail to get an understanding of where we're at and where we're going, as well as the macro and micro risk factors that will determine the eventual path of the Russell 2000. We have a lot to talk about in the special weekend edition of the show, so let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. It really helps me out. Let's get into it. Now, this is the S&P 500 weekly heat map. So a very red day across the board today, guys, except for, well, the names you can see. Google, Meta, Amazon, Microsoft, too. Those names just refused to sell off today. Meta was so resilient. I hold a big portion in my portfolio of Meta, and it's the reason why my personal portfolio was actually net green this week, despite the violent red across the board. Look at consumer defensives, utilities, healthcare, right? Defensive stocks, even telecom services right here in the red. So this week was marked by liquidation. There wasn't a defensive rotation. The only thing you could say there was a rotation into was energy. And energy isn't really a defensive sector. It's more of an inflation hedge. We also saw the same true here with basic materials. But out of the two, oil is far more sensitive to inflation than any other commodity. But look at consumer cyclicals. Other than Amazon, guys, red across the board, financials, real estate, a lot of parts in technology. Some were pretty much flat. Semiconductors were half and half, but when Nvidia's down, the whole sector is going to go down. But looking at individual sectors, we saw the best performing sector, GDX and XLE, my top two performing sector picks for this month. Number one and number two right now. We saw metals and comm services hang in there. They both produced a percentage point worth of gain or more. The worst performing sectors, regional banks, home builders, healthcare, real estate, so rate sensitive sectors, they were the worst performing sectors. And then everything was like in the middle. We had like software, semis, financials, they all lost ground on the day. And this led the major index, the S&P 500, to be down 0.91% for the week. The nasdaq, the best performing sector, down 0.75%. The RSP took it on the chin, down 1.76%. And then smalls, down 2.78%. An actual dumpster fire in small caps. Now guys, the weekend poll is currently up and running, so go ahead and vote. This was last week, and 46% of you were bullish, and as you can see, we finished down on the week. So this is 100% a contrarian indicator, and we're actually getting a decent amount of votes now. We can actually say that the sentiment votes is like statistically significant in terms of being a contrarian indicator. I remember when I started this, guys, we were getting like 50 votes on the nose. Look at how much this channel has grown, and I thank each and every single one of you. So go and vote on the weekend poll. It's just in the YouTube community tab. Now this is the monthly chart for the IWM. We covered the S&P 500 yesterday. We're now going to cover the IWM. Now the monthly chart, I know the month has just started, but there's a couple of glaring things we need to look at. Number one, let's draw a trend line right here. That's a very key support zone. Let's actually change that color. Now, a couple of very key things. Number one, we use this green line as resistance, which turned to support kind of right here as we are attempting a breakout above this 199, let's call it 200 level, to hit new all-time highs. And I do think that breakout is going to happen if earnings for the IWM this quarter come in really good. Now, earnings were an absolute dumpster fire in Q4 2023, so they really do need to put in work. That being said, we are starting to see a breakout, especially from the lows right here, but we are having a bit of trouble above the 200 handle. But as you can see, this month, we've erased nearly all of March's gains in a single week here in April. After rates climbed, small caps absolutely dumped. The second you get market volatility and uncertainty, you're going to sell high beta, you're going to go into treasuries, you're going to go into commodities, you're going to go into bonds, you're going to go into large cap quality. And that's what we saw this week. Look at the winners this week, right? Google, Meta, Amazon, high quality, large size. And that tends to happen when it's risk off and people get worried about the economy, the global economy, you see a flight to quality. Let's hop on the weekly chart, and we see a couple of glaring things. Now, we are in the context of an uptrend. We do have to understand that, like, this chart, very bullish. Nonetheless, we're just kind of like having a correction in time, stalling out here. Now, we do have to put in a second line on the weekly chart. That's a very important line, and it does mark two major zones for the weekly. Now, if the 199 is violated anytime, I do think that we're probably going to push very close to the 199 area, and this is going to be a very key level. And if we do break below this level, we could see these downside levels, especially if it coincides with rates moving higher. That being said, we are 1 to 2 percentage points away, and I would use this as next week's line of support right here, the 199 level. This is an absolute critical zone that bulls need to hold. If they don't, we're going to see movement to the downside. Now, let's actually hop on the daily chart, right? And we're going to keep those same levels, and we can start to see a pattern forming here on the daily chart. Now, it is going to take at least 5 to 10 trading days to set up, but we can see that this could be a shoulder head right here. And then if we form another shoulder, break this neckline, that could be pretty dangerous, especially if we form a lower low here against this low right here below the 199 area. We can then see a pretty vicious move to 191, where bulls will need to absolutely, gather support. Otherwise, we could see lower levels in the IWM. Now, we do have to look at this in context, and we've put in a low, higher low, higher low, higher low, higher low still, and technically, we actually have put in a higher low for the week. At the same time, we did put highs right here, equal highs, I guess. You could say a marginal lower high, but inconsequential, and then a higher high right here. So if we do just form a bottom here, rally, or even form a bottom right here, maybe make an equal low and then rally, that would still mean the uptrend is intact. It just becomes problematic below the 199 area. So 199 and 191 are your key support and downside targets. But what about upside targets? So for upside targets, the only level we should be looking at right now is 223. And if we can hold the 199 support and rally off that support level, 223 should be a fairly achievable target as long as Q1 earnings report in line. Earnings is one of the two major risk factors that you need to be aware of when trading small caps. These things are going to determine flows and movement of the Russell 2000. The very first one is Q1 earnings, okay? Are earnings going up? Are earnings improving on a year-over-year basis? And are margins expanding? That's going to be your number one driver. The second is going to be the 10-year, okay? Yields. Are yields going up? Are yields going down? Small caps are super rate sensitive. 41%, something like that, of small caps are unprofitable. 50% of them have floating rate debt that matures in the next 18 to 24 months. Now, small caps can rally if yields go up and earnings go up. But if earnings go down, yields go up, expect a massive dump in small caps. So look at earnings, look at yields. Earnings is your number one proxy. The biggest mover is going to be earnings, and then yields after that. But let's talk sentiment. So we got the Goldman Sachs bull bear indicator. This keeps ticking down. It was at 5.8 last week. It was at 7.1 a couple of weeks ago. It's now at 5.3, and it's actually closer to the 5 mark than it is to the 6 mark, which is absolutely insane. We're getting very close to this buy zone right here, this section here. And if we do move into this section here in the BOFA bull bear indicator, I would actually say load up on stocks, because this indicator is very reliable. At the end of October, this indicator was pretty much at 0, and had you bought then, you've been up 25-30% in the S&P 500. At the same time, something we're seeing, margin debt. This is the margin debt historical trend. This is where it currently is right now. So it's slightly above its historical trend line. However, you do have to take into consideration that it's well below optimistic and very optimistic, which means that margin debt is looking healthy and that a lot of the market still has a lot of firepower left, both in money market funds, but if they need to leverage up, they can also do that as well. And historically speaking, when you do get to this very optimistic mark, that is a great sell signal, and very pessimistic is a great buy signal. And we're not quite there yet. So there is a lot of gas in the tank. It doesn't mean we're going to absolutely rally next week, but it does mean that any pullbacks we do get, you do want to buy stocks, buy equities, and hold. Both these indicators are telling us that it's either time to buy equities, hold equities, or it's going to be time to buy very, very soon, especially if this indicator keeps trending the way it is. Now, let's actually talk about non-farms because I kind of brushed over it yesterday. I was trying to get the video out as quickly as possible. I had a couple of things to do. However, guys, we got 303 non-farms. A lot of people saw that as a hot number. 200,000 private payrolls, 71,000 government. Average weekly hours actually came cooler than expected. We were expecting 34.5. We came in at 34.4. Average hourly earnings came in at 0.3%. That was also cooler than expected because that number was actually 0.29. It was just rounded up to 0.3. So average weekly hours as well as average hourly earnings month over month came in a lot cooler than expected. And that's actually why the market didn't sell off on this figure right here, because this pretty much just says that people have jobs, but wage inflation based on weekly hours and hourly earnings is actually falling, and Wall Street tended to like that. And that's why stocks rallied on Friday. Also because of the fact that I think a couple of the big institution names got the data leaked to them and then they sold on Thursday, and then Friday was sort of like buy the news instead of sell the news. But the unemployment rate actually went down to 3.8%. That came in line. Participation rate was in line. Everything was pretty much in line, but the inflation metrics of the report actually came in a little bit cool, and that is going to support equities into next week. Now, let's actually talk about the economy. Now, I know this is a terrible chart, very, very blurry, so I apologize, guys, but this is some data here from Goldman, just their expectations for the year ahead. And they say our 2024 GDP growth forecast is well above consensus expectations, but it's not far above short-term potential growth. We still expect a meaningful decline in inflation. So you can see by this chart right here, US quarter-over-quarter GDP growth is much higher than the actual consensus, as you can see right here. And then Goldman also expect core PCE inflation to fall meaningfully, enough for the FOMC to price in 3 cuts. So essentially Goldman is saying higher GDP, disinflation, 3 cuts. That's what their expectation is. Now, with regards to their cuts, that's actually in line with the current implied policy rate changes. So we are still expecting the first rate cut to occur here in June, and then the next one in September, and then another one in December. That is the current policy rate expectations priced into Fed fund rate futures. So Goldman and the market are consensus on still 3 cuts this year. We'll have to see how that plays out with PCE, CPI. There's still a lot of data prints that the Fed can draw on to make their decision. And I do think that it's not unreasonable to expect 2 to 3 cuts this year. Now, on the topic of data points this week, here are key events. So guys, we have Kashkari speaking here on April 8th. Then on Wednesday, April 10th, we have the CPI month over month, year over year. So the expectation for that is 0.3 and 3.4% year over year. Then we also have core CPI, and the expectation for that is 0.3, 3.7. Then we also have FOMC minutes. And then on Thursday 11th, we have PPI headline and core, 0.3, 2.3 for the headline, and then core, so ex food and energy, we're looking at 0.2% and 2.3%. Now, just diving into core PCE, because this is the figure that the Fed look at a lot, excluding food and energy, because it's quite volatile. The consensus right here is 0.3%, but if we actually dive into the specifics, that's actually the rounded up figure. What the market is actually expecting, or should I say what BOFA is expecting according to Harvard Analytics, is a 0.24% forecast increase to core CPI this coming Tuesday. So if we get anything above this number, now it is going to be rounded up. Anything above this is going to be considered hot. Anything below this, the market will consider cool. Now, some more event-driven data. This week, we have earnings. Q1 2024 earnings season kicks off this week. We have a couple of big names, Delta Airlines, the WD-40 company, but on Friday, that's really when it's all happening. We have JP Morgan Chase, Wells Fargo, BlackRock, Citigroup, Progressive Insurance, PGR, and then State Street Global. So a very big week. They're kicking off earnings on Friday. So what are our expectations? Now, this is according to LSEG data, IBES. Now, financials are expected to report 4.8% growth here in Q1. The S&P 500 is expected to report 5% growth, ex energy 8.1% growth. Now, I also have Goldman Sachs data right here because it's a bit different for Goldman Sachs. They're actually expecting 3%, and if you exclude energy, 6% growth quarter over quarter. Now, they actually go ahead and list a whole bunch of other stuff right here. So excluding financials and utilities, 3% growth, and then excluding energy, financials, and utilities, 7% growth. But I don't know why you do that. These are a part of the index. Now, I have no idea why Goldman Sachs would give the S&P 500 margin, excluding financial and utilities here at 10.9%, but not give us the margin for the S&P 500 as a whole. Very, very weird, but that's what they've done. We are expecting, excluding financials and utilities, a 10.9% margin, 11% inclusive of energy, and that's actually going to be a 2 basis point and a 34 basis point increase year over year. Now, diving into the top 10 stocks, because these guys are expected to drive the majority of growth in the index. You can actually see here the top 10 are expected to report year-over-year sales growth of 15%, year-over-year EPS growth of 32%, and net margins of 23%. That's 380 basis points increase year-over-year. Now, let's compare that to the S&P 490, right, which is expected a 2% growth year-over-year sales growth, a 4% decline in EPS, and 11% margins, a 57 basis point decline year-over-year. And so you could actually see that the top 10 stocks is really holding the weight of the S&P 500 earnings this quarter for Q1 2024. Now, looking at earnings revisions for 2024, they have been above average. This right here is your average here. This right here was 2023, and you can actually see that this is how we're trending right now in 2024. And guys, I'm going to tell you right now, if we start getting upward revisions for the rest of 2024, let's say this earnings season comes in really, really good, we get upward revisions, that is going to be absolutely insane. Now, generally speaking, whatever earnings are, we normally do expect downward revisions because analysts tend to be quite bullish. And so when we do see revisions above the historical trend, that is normally very, very bullish. Now, again, guys, looking back at the top 10 stocks for the S&P 500, these are consensus revisions, and you can see that the top 10 have had massive upward revisions, plus 18%, versus the S&P 500, who's actually down 1% and then down 6% for the S&P 490. So again, a lot of earnings is based on these top 10 names, and there's two major financial names in these top 10, JP Morgan, Berkshire Hathaway, and so they really have to hold it in there for financials, particularly JP Morgan. Nonetheless, earnings this quarter is going to be massively driven by the top 10 largest stocks in the S&P 500, and they really have to outperform. Otherwise, we are going to get a material pullback in price in the S&P 500, and particularly look at Nvidia, guys. Nvidia is driving the bulk of these earnings revisions to the upside. Now, looking at S&P 500 margins, now margins are actually coming in a lot lower than the previous quarters here in 2023. However, do take into consideration that margins are actually increasing versus the first quarter last year, and this quarter they are actually expected to inflect and then move higher in Q2, Q3, and Q4, topping 12% double-digit net profit margins here in the S&P 500. So this is the inflection point, and if we can get better margins than expected, better earnings than expected, I don't see why the S&P 500 won't continue to rally to 5,300 and beyond. Guys, and just some data I wanted to bring back to your attention. This is the S&P 500 returns into and after non-farms, and we said that normally heading into a non-farm payroll event, it actually can be quite negative, and then the day after tends to be quite positive. And despite all of the shenanigans we've seen this week and the volatility, that has held true. We actually saw we were down 1.2% heading into the non-farms, and we actually finished the day up 1.1%, which is in line with seasonality. We normally see one day negative 0.06 and then the day after positive 0.3. Now, the hit rates aren't that great, so do take it with a grain of salt. That being said, the data doesn't lie, and had you taken this trade that I did give to you guys well in advance, you would have had a very profitable trade, especially if you bought at the lows the day before non-farms. If you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.